Hey guys, what's going on? It's your big dreamer and doer, G Dinero, coming to you today with another episode of Breaking Down the Trade. Today, it's Invest Answer's latest synthetic long, which this one is a HIMS June 18th, 2026 $40 call, coupled with a December 18th, 2026 $35 put. It is a custom synthetic long. Please remember, none of this is tax, financial, legal, investment advice. It's your buddy G Dinero helping you increase your financial literacy to help put you and your family on that path to financial future. Now that we've gotten that out of the way, let's dig in. So here was the trade alert and the rationale. First of all, HIMS got hit hard yesterday. This is what Invest Answer said. HIMS got hit hard yesterday after analyzing the data and the impact of the loss of Wegovy, the weight loss product. It should only result in about a 15% loss of revenue. So Invest Answers entered into a synthetic long when the share price was around $42.15 as he waited for the trend to turn. The Confluence model was also about to flash a buy signal, and break even on the trade is $45. He also stated that the CAGR, the compound annual growth rate, is extraordinary, and he believes that it is oversold. So this is what the charts look like in his trade alert. On the upper left-hand corner, note that's a 4-hour ATR chart. And on the ATR, HIMS had pulled back to level 4, just below level 4 on the ATR chart. Previously, it hit a high of about $73 a share back in February, and since then dropped in April all the way down to about $24 a share, spiked back up to 64, and had pulled back to 42.15 at the time when James did the trade. Invest Answer sold the HIMS 12, 18, 26, $35 put. So the December 18th, $35 put, and he bought these, the HIMS June 18th, 2026 $40 call. On the lower right-hand corner, he did also post the mean reversion chart. It's a 4-hour mean reversion chart, and noted, quote, mean reversion has never been so low, end quote. And you can see that it was almost 3 standard deviations below the mean on that mean reversion chart on the lower right-hand corner. So what does the trade look like? Well, Invest Answer sold the December 18th, 2026 HIMS $35 put for $12. That means he collected $1,200 for selling this put. He had to have $3,500 to collateralize the put. Again, Invest Answers uses margin to collateralize his trades, but that's due to the assignment risk. At any time between now and December 18th, 2026, the opposing party can assign their shares of HIMS to James for $35 a share times 100 shares, or $3,500. Okay, so Invest Answers needs to keep $3,500 worth of margin or cash available to secure the put at any given time. Invest Answers bought the June 18th, 2026 HIMS $40 call for $17, spending $1,700 in the process. So I know a lot are going to ask, why do them staggered like this? Not only is this a diagonal trade because the expiration dates are different, but you also have a staggered trade where the puts were sold at $35 and the calls were purchased for $40. The reason to sell the puts longer out into the future is you'll collect more premium in doing so. But by selling them at $35 instead of $40, you're using up less collateral. And thus, if there's less assignment risk also, because HIMS would have to really drop in order for you to get assigned in this case. You use up less collateral, but by going out longer in the time frame, you're collecting more premium as a result, right? If he would have done the June 18th, he may have only been able to collect $8 to $10. I didn't actually look to see. If he would have done the 40s, he might have been able to collect a full $14 or $15 a share, but there would be a larger assignment risk for a longer period of time. He's hoping that the trade goes in his favor. It goes well above 35 by the time June 18th, 2026 rolls around. The puts are nearing expiration. There'll be very little value left on them, and the calls will go up in value. This trade then resulted in a net debit of $5 a share, or $500. So you take the $1,200 that he collected minus The $1,700 that he spent, that's $500 that he spent, or $5 a share net debit. The break even on this trade thus is $45 by December 18, 2026, which is taking the $40 strike price for the call and adding $5 to it for what he spent in the overall debit on the trade. So what's the biggest risk? As always, that HIMS goes to zero and you're assigned shares at $35 a share times 100 shares, and you spent $3,500 on something that is worthless. Again, the likelihood of that very low, but you have to have that included in there. That would also result in a loss of $3,500 plus the $500 that he spent up front, the net debit on the trade, or $4,000 total. Now, we're going to take a look at it on Optionstrat. I did include my link up there. I use the paid version of Optionstrat. It's, I think, like $150 a year. And you can find that at optionstrat.com/GDinero. Just a little quick plug. So this is what it looks like building a custom synthetic long here on Optionstrat. You see the $40 call option for $618.26, the $35 put for $1218.26, and the net debit of $500. At the time when I took this screenshot, this trade was already up $70. So on the $500 that he spent up front, he was already up $70 on that trade. That's the unrealized gain at the time I did this. And that's because HIMS went up just a little bit from what it was at 42.815, I think, when he said he entered, to 42.95 at this point. I'm assuming on this that HIMS goes up 100% between now and June a year from now. Okay, so June 18, 2026, that HIMS goes up and does a 100% increase from where it is here. Again, Invest Answers is very confident that HIMS is oversold, is undervalued, that it's growing the revenues at a 78% compound annual growth rate. So if that's the case, he's assuming that this is going up and to the right. So I just arbitrarily used 100% increase from where the share price is today. So from $43 to $86. Note that the puts would still be in play at that point. The puts would still have about 6 months left on them. Okay, so that collateral would need to remain in there. You'd have $3,500 worth of collateral still at risk at that point. At $86 a share, now we're going to read down the right-hand side, at $86 a share by June 18, 2026, these contracts would be worth $44.66, or $4,466, okay? That is the put, which you would be able to sell for $86. Sorry, that would be the call, which you would be able to sell for $86 minus the $40 call option, right? So $86 minus the $40 call option, the strike price, is $46 or $4,600. Then you'd have to subtract from that what you would have to buy to close the put for, because again, it would still be open. And this is saying that you'd be able to buy to close that for about $1.35 a share, netting you $44.66 a share. So again, the call is worth whatever the shares are going for, in this case, $86, minus your strike price. 86 minus 40 is 46. Then you'd have to subtract what the put would be going for at the time, about $1.34. That would bring the total to $44.66 that you could sell these contracts for at that time on June 18, 2026, if it's at $86 a share. That would be a $3,934 profit on a $500 initial investment, or a 7.9x return. Again, the puts can be closed at any time along the way. You could always exercise the call options if you indeed wanted the shares and wanted to go a little bit longer in this trade. In that case, you would need to come up with $4,000 for each call option to exercise the calls. That would make your cost basis on those shares $4,000 plus the $500 that you spent up front, or $4,500. And if you rode it out until the puts ended up expiring worthless, that would be it. There would be no other expenses, and you would be completely out of the trade, and you would have exercised the call option side of things. If you want to see more content like this, make sure you like this video. Make sure that you comment below. What'd you like best? What would you like to see more of? What did you learn today? That's what I love hearing, is what people learn. And make sure you're subscribed to the channel so you don't miss any of these updates that I do along the way. If half or more of what I was talking about today sounds like gibberish to you, you need to book one of my coaching courses. I would highly suggest the Understanding Options course. I'll put a link to it here, but if you go ahead and book that course, it'll go over everything with you, from the terminology that I'm using to the Greeks data, which I didn't really talk a lot about today, to how each of these trades works: buying a call, selling a call, buying a put, selling a put, combining them into strategies like synthetic longs and even custom synthetic longs like this. You'll learn all of that and more at my Understanding Options course. I also teach a course on TradingView and technical analysis, as well as book individual appointments at gdinerocoaching.com. All the information's over there. And remember, guys, I'm G Dinero. I'm here to help you increase your financial literacy, to help put you and your family on that path to financial freedom. We'll see you soon. Take care.